Fed decision is
the
coming
committee
up.
decided today to extend the average maturity of its holdings of securities. The committee intends to purchase by the end of June 2012 $400 billion of Treasury securities with remaining maturities of 6 years to 30 years, and to sell an equal amount of Treasury securities with the remaining maturities of 3 years or less. This program should put downward pressure on longer-term interest rates and help make broader financial conditions more accommodative. In addition, to help support conditions in mortgage markets, the committee will now reinvest principal payments from its holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities. In addition, the committee will maintain its existing policy of rolling over maturity Treasury securities at auction. The committee also decided to keep the target range for the federal funds rate at 0 to 1/4% and currently anticipates that economic conditions are likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013. There was also some new language on the economy, the Fed saying there are significant downside risks to the economic outlook, including strains in global financial markets. There were 3 dissenters today voting against the action: Fisher, Kocher Lakota, and Plosser. Again, 3 dissenters. Mark?
Megan Hughes joining us from the Treasury. Megan, thanks. Let's go back to Washington and our economics editor, Michael McKee, for some analysis on what we just heard from Megan. What's your quick bottom line on this, Michael?
Well, this is Operation Twist, and it's the aggressive version of it. One possibility would be that they just reinvested the maturing securities that they already held in their portfolio, but they say they're actually going to sell short-term securities, invest them in the 6 to 30-year space. Now, that's interesting because a lot of people were focused on the shorter end of the long end. In other words, the 5 to 10-year space or the 7 to 10-year space. The fact that they go out a little farther has some implications for the markets because there are fewer 30-year notes out there, 30-year bonds out there, and they also expose the Fed to more interest rate risk. You're holding on to them for a lot longer time. The other interesting thing is that they're going to start buying some agency securities again, mortgage-backed securities. One problem that we've seen, Mark, is that mortgages have come down. They are at record lows, mortgage rates, but the spread, the rate between what the banks pay for cash and what they lend it to you to buy a house at has not. It has widened. And this is an effort to try to bring that down and perhaps give a little extra kick to the housing market. $400 billion, an interesting number, a little bit less than QE2, less than some people had expected, but more, as we say, than if they had just used the reinvestment that they had talked about in the first place.